While President Trump sends global markets into turmoil with a wave of new tariffs targeting Canada and the auto industry, a different kind of earthquake is unfolding behind the scenes. China has just signed a historic energy deal with Canada, offering Ottawa a strategic lifeline and landing an unexpected blow to Washington's trade strategy. Meanwhile, America's auto industry is grappling with a supply chain crisis, soaring vehicle prices, and an agricultural sector reeling from Beijing's retaliatory measures. Is the U.S. isolating itself, while its rivals quietly rewrite the rules of the global game? Canada and China forge a quiet revolution in energy trade. In a move that's gone largely under the radar of mainstream Western media, a seismic shift is occurring in the global energy equation. As former U.S. President Donald Trump revives his protectionist playbook with a 10% tariff on Canadian oil and gas, Beijing is turning this obstacle into an opportunity. In a strategic pivot that reflects both geopolitical pragmatism and long-term vision, China has deepened its energy cooperation with Canada, creating a partnership that could permanently realign supply chains and influence future market dynamics. At the center of this alliance is Rongsheng Petrochemical, a massive Chinese refiner with a daily capacity exceeding 800,000 barrels. Its recent expansion into Calgary, the heart of Canada's petroleum industry, is more than symbolic. It signals the emergence of Canada not just as a passive supplier, but as a proactive energy partner for Asian economies. As Washington weaponizes tariffs, China is building bridges, literally and economically, by investing in logistics, refining infrastructure, and long-term import agreements. Canada's pivot towards China is not merely reactive. It's a calculated repositioning. The reliability of Canadian energy, paired with China's insatiable demand and decoupling from U.S. dependencies, creates a new corridor of influence that bypasses traditional Atlantic power dynamics. This isn't just an energy deal, it's a redrawing of the global economic atlas. The Boomerang effect, Trump's auto tariffs unravel an industry. Trump's latest volley in his economic nationalist campaign, a sweeping 25% tariff on all foreign-made vehicles, has backfired with spectacular force. Market data and supply chain metrics paint a stark picture. Vehicle prices have surged, parts shortages are mounting, and American automakers are facing both logistical nightmares and public backlash. A $48,000 vehicle is now expected to cost around $60,000 post-tariffs. But the real damage lies beneath the surface. Even American-assembled icons like the Ford F-150, long marketed as the pride of U.S. manufacturing, are deeply entangled in a web of global supply chains. With thousands of components sourced from countries like Mexico, South Korea, and Canada, the tariff's reach extends far beyond finished imports. Steel and aluminum tariffs further compound costs, inflating prices by another $400 to $600 per vehicle. Rather than reinvigorate American factories, these tariffs are accelerating a different trend: automation. Companies are avoiding the massive expenses required to reshore supply chains by turning to robotics and AI. The North American auto ecosystem, once a success story of trilateral integration, is now fragmenting under the pressure of short-term political theatrics. China's ascent: efficiency over force, innovation over ideology. As the United States stumbles through a fog of protectionism and bureaucratic gridlock, China has quietly rewritten the rules of industrial dominance, particularly in the automotive sector. In 2025, it formally overtook Japan to become the world's top car exporter, a milestone that reflects not just economic prowess, but strategic clarity. But China's rise is not simply a tale of cheaper production. It's a lesson in intentional design. State-backed investment in core technologies like lithium refinement, solid-state batteries, and AI-driven manufacturing has made Chinese automakers not only faster, but smarter. While Washington debates over critical mineral sourcing and energy security, companies like BYD, Geely, and NIO are already deploying next-gen vehicles across Southeast Asia, Latin America, and even the European periphery. Perhaps most importantly, China has embedded its manufacturing strength within a broader Belt and Road framework. Ports in Kenya, freight rail in Central Asia, and electric bus factories in Hungary are no longer just infrastructure projects. They are extensions of China's industrial reach. As one European policy analyst observed, the Chinese car doesn't just arrive, it brings with it the system that made it. In contrast, the U.S. continues to oscillate between short-term stimulus packages and politically charged tariffs. Despite significant talent and resources, America's auto industry remains vulnerable to fractured supply chains and policy uncertainty. The era of relying solely on brand prestige and national loyalty is fading, replaced by a demand for speed, affordability, and technological harmony. China rejects U.S. beef as Russia builds a parallel trade network. The early days of March 2025 delivered a jarring wake-up call to U.S. agriculture. With surgical precision, China blocked over 150,000 tons of American beef, officially citing sanitary concerns. But the real message was geopolitical: retaliation for Washington's 25% tariff on Chinese electric vehicles. This tit-for-tat maneuver had profound consequences. Ranchers across Texas, Nebraska, and Kansas faced a glut of unsold meat, plunging prices, and shuttered contracts. While federal subsidies were promised, the larger damage was reputational. China, once the largest importer of U.S. beef, is now actively decoupling from that dependency. Seizing the moment, Russia capitalized. A new high-speed freight corridor, connecting Volgograd to the Chinese city of Sany, has turned the vast expanse of Eurasia into a strategic lifeline, with rail transport reducing shipment times from 4 weeks by sea to under 2 weeks by land. Russian beef exports to China soared 32% in just the first quarter of 2025. But the shift goes deeper than logistics. Nearly 90% of Sino-Russian beef transactions are now settled in rubles or yuan, signaling a quiet but deliberate erosion of dollar-based trade. Moreover, Russia has proposed using blockchain-based tracking systems to monitor livestock health and compliance, appealing to China's growing demand for transparency in food imports. This isn't merely a supply substitution. It's the forging of a new commercial order, where political alignment and infrastructure symbiosis increasingly determine trade flow. As America clings to old alliances and punitive tariffs, the rest of the world is building alternatives, not just in trade routes, but in monetary systems and digital frameworks. In this new era, the battleground is not defined by force, but by flexibility. The winners will be those who can reroute, reimagine, and realign, with or without Washington's approval. Trump's radical territorial proposals. In an era defined by multilateralism and the defense of national sovereignty, Donald Trump's renewed musings about annexing Canada and acquiring Greenland feel not just provocative, but anachronistic. His assertion that the U.S.-Canada border is merely an artificial line is not just historically revisionist. It's a window into a worldview that sees geography as negotiable and sovereignty as a tool of convenience. While some dismiss these comments as political theater aimed at energizing his base, their implications echo far beyond North American borders. Canada, with its robust democratic institutions, independent foreign policy, and deep ties to global diplomacy, swiftly and unequivocally rejected the notion. Yet the very suggestion of such an annexation reflects an unsettling disregard for the core principles of international law, most notably the sanctity of national self-determination. It's reminiscent of 19th century manifest destiny, rebranded for the age of social media. Even more concerning is the resurrection of Trump's Greenland ambition. First proposed in 2019 and quickly dismissed as diplomatically tone-deaf, The idea has returned with a more ominous twist. Trump now hints that NATO, originally founded as a mutual defense pact, could be leveraged to support such a move. This reveals not only a fundamental misunderstanding of the alliance's purpose, but also risks eroding the credibility of Western diplomatic norms. Greenland's strategic value is not lost on global powers. Beneath its icy terrain lies an abundance of rare earth minerals, key components for technologies like semiconductors, EV batteries, and advanced military systems. China has already invested heavily in Arctic research and infrastructure, while Russia has militarized parts of its northern frontier. In this context, Trump's vision appears less like a misguided real estate pitch and more like an attempt to carve out influence in one of the planet's last great frontiers. But the world is not what it was a century ago. Global governance today is built on consent, not conquest. The backlash to Trump's proposals, from European allies to political moderates at home, reveals a growing discomfort with aggressive, territorial rhetoric in an increasingly interconnected and pluralistic world. Rather than reinforcing America's position on the world stage, such ideas risk isolating the U.S., alienating allies, and undermining the very international order it once helped build. In many ways, these proposals are a microcosm of a broader shift, one where populist nationalism collides with the legal and moral frameworks of the 21st century. The message they send to the international community is clear. For some leaders, borders are not barriers to cross respectfully, but assets to acquire. As the geopolitical chessboard evolves, the question is no longer whether such ideas are viable, but whether the global community is prepared to resist their normalization. Trade as political theater, the Canada tariffs. What began as an economic policy debate has quickly devolved into a spectacle of political theatrics. By imposing steep tariffs on Canadian lumber, energy, and automobiles, former President Donald Trump has transformed trade policy into a high-stakes performance, where diplomacy takes a backseat to campaign optics. While he frames these measures as a push for economic independence, economists across the political spectrum are sounding the alarm. These tariffs are less about strategic leverage and more about short-term political gain. Canada, far from being an economic adversary, is the United States' second-largest trading partner. Its lumber supports the U.S. housing market, its oil fuels key industrial regions, and its automobile parts are embedded in the very vehicles assembled across American factories. The North American supply chain is a tightly woven web, and unraveling it under the guise of nationalism threatens to backfire, economically and geopolitically. The consequences are already taking shape. Home-building costs have surged due to inflated lumber prices, and U.S. automakers, reliant on Canadian parts, are warning of delays and rising vehicle prices. In some sectors, particularly energy and raw materials, there simply isn't an immediate domestic substitute. The result? American consumers pay more, manufacturers face uncertainty, and inflation creeps upward, ironically undermining the very economic confidence Trump claims to champion. But the economic fallout may not be the most disturbing element. In a recent off-script remark at a political rally, Trump revealed a cynical strategy behind his messaging. Referencing the culture war issue of transgender athletes in sports, he stated, bluntly, "I told Republicans, don't bring it up until the week before the election." It was an admission not of moral conviction, but of calculated distraction, a diversion tactic designed to divide and inflame the public, shifting attention away from the real economic pain points, like rising prices and trade instability. This tactic isn't new. Political scientists have long studied the use of wedge issues to polarize electorates and suppress critical economic debate. What's alarming now is how openly the strategy is being acknowledged. Trade policy, rather than being informed by long-term national interest, is increasingly shaped by headline-driven populism, where allies become targets and economic disruption becomes a talking point. Meanwhile, global competitors are watching closely. As the U.S. picks trade fights with its neighbors, China and the European Union are doubling down on regional cooperation. Canada, once reliant on American markets, is actively diversifying its trade portfolio, striking deals with the EU, India, and ASEAN to reduce dependence on a volatile partner. In this landscape, trade has become more than an economic tool. It is a political weapon, wielded less for prosperity and more for performance. The long-term cost? Damaged alliances, strained supply chains, and an erosion of trust that will outlast any single election cycle. Trump's NATO comments and the European fallout. Trump's offhand suggestion that NATO could assist in annexing Greenland, a territory belonging to Denmark, was not just provocative. It bordered on diplomatic sabotage. European leaders, already wary after years of transatlantic strain, reacted with disbelief and alarm. While some dismissed it as political theater, others interpreted it as a deeper threat, the erosion of shared democratic norms in favor of transactional nationalism. The fallout was immediate. In Brussels, quiet discussions about strategic autonomy gained new urgency. France's Emmanuel Macron revived his call for a European army, not just to defend against external threats, but to hedge against unpredictable American leadership. Meanwhile, in Berlin, policy analysts began reevaluating Germany's reliance on U.S.-led security guarantees, especially as military budgets across the continent are already under pressure due to inflation and energy transitions. What's more, the comments came at a time when NATO is actively expanding its coordination in the Indo-Pacific, hoping to counterbalance China's rise. Trump's rhetoric undermines those efforts, casting doubt on whether the U.S. can be relied upon to support allies beyond the scope of its own interests. For many European policymakers, the message was clear. If the U.S. is willing to turn defense alliances into bargaining chips, then Europe must prepare for a future of strategic self-reliance. Economic turbulence, rising prices, falling trust. The new tariffs, sweeping and often imposed with little warning, have rattled global markets and domestic confidence alike. A 5% drop in the Dow in just 1 month might seem manageable in isolation, but it occurred in tandem with growing labor market softness and worsening inflationary fatigue. For ordinary American families, it feels like déjà vu. Grocery bills are rising again, mortgage rates remain painfully high, and wage growth is stagnant in key sectors like logistics and construction. Internationally, the uncertainty is having a ripple effect. Global supply chains, already tested by the pandemic and war in Ukraine, are now bracing for a new era of trade fragmentation. Southeast Asian economies, once keen to align with U.S.-led trade frameworks, are increasingly turning to regional alternatives like RCEP or the China-ASEAN Free Trade Area, where policies appear more stable and less driven by electoral cycles. Domestically, Trump's attempt to scapegoat globalist elites is wearing thin. Polling from Pew and Gallup shows a sharp decline in confidence, particularly among independent and suburban voters, two groups crucial for winning national elections. Even Tesla's 20% stock drop, despite solid revenue growth, illustrates a wider investor anxiety. It's not just earnings that matter anymore, but whether a company can navigate a geopolitical minefield of tariffs, sanctions, and policy U-turns. In essence, what's unfolding is more than economic turbulence. It's a crisis of credibility. When markets lose faith in policy direction and households stop believing in recovery narratives, the long-term consequences can echo for years, reshaping not just trade, but the very social contract between citizens and the state. Mounting debt, mounting risk. The ballooning of the U.S. national debt by over $8 trillion under Trump's tenure is more than a statistic. It's a ticking time bomb embedded in the core of American economic architecture. While inflation appears to be slowing on paper, the foundational cracks in fiscal governance are growing wider. The most concerning part isn't just the sheer scale of debt, but the absence of a long-term strategy to address it. Financial markets have already reacted with alarm. Since late 2024, $3.5 trillion in market value has been wiped out, a stark reflection of investor uncertainty. As interest payments on debt consume a larger portion of the federal budget, essential public services, from infrastructure to education, face budgetary constraints, limiting the government's ability to respond to future crises. What's particularly troubling is the over-reliance on tariffs as a revenue and leverage tool. While these measures are often presented as defensive economics, they've only exacerbated inflationary pressures and fractured critical trade relationships. Tariffs can't replace structural reform. They're a short-term political device, not a sustainable economic solution. From a broader global perspective, the credibility of the U.S. as a financial anchor is also slipping. Credit rating agencies have already sounded alarms, and the IMF has warned that the U.S. risks losing its safe haven status if fiscal discipline continues to erode. In a world where capital is fluid and investors are increasingly global, confidence is currency. Without restoring fiscal responsibility, the U.S. risks not just recession, but a diminished role in the future of international finance. A credibility crisis, tariff flip-flops, and strategic confusion. The erratic nature of recent U.S. trade policy has not only perplexed economists but also strained diplomatic relations with key allies. In what many now describe as a pattern of strategic whiplash, the U.S. has oscillated between punitive tariffs and abrupt reversals, targeting Canadian lumber one month, Mexican steel the next, only to walk back the measures weeks later. While the official rationale often emphasizes national security or domestic economic protection, many analysts see these moves as reactive improvisations rather than parts of a coherent strategy. Such unpredictability has a corrosive effect. In the realm of international trade, consistency is a currency of trust. When the world's largest economy acts on impulse rather than long-term planning, it sends a chilling message to partners and investors alike. The rules may change overnight. Emerging markets in particular are watching closely. Countries in Southeast Asia and Africa, long courted by both the U.S. and China, are increasingly hedging their bets. Vietnam and Indonesia, for instance, have begun deepening trade ties with the EU and regional blocs like RCEP, fearing that reliance on U.S. markets could expose them to similar policy reversals. Meanwhile, China has skillfully positioned itself as the reliable alternative, touting long-term infrastructure commitments through Belt and Road projects and stable, low-tariff trade routes. Even within North America, the credibility gap is widening. The constant back and forth on USMCA enforcement, for example, has undermined investor confidence in the continent's supposedly integrated supply chain. Automotive companies are now reconsidering expansion plans in border towns due to fears of sudden regulatory changes, higher import costs, or labor clause disputes. Perhaps most telling is the shift in sentiment among multinational corporations. Many firms that once saw the U.S. as a safe haven for manufacturing and logistics are diversifying away, not just to avoid tariffs but to escape policy volatility. From German chemical firms to Japanese electronics giants, the message is clear. Predictability matters more than patriotism. This strategic confusion is not just a diplomatic liability, it's a geopolitical own goal. While Washington insists it wants to lead in reshaping 21 century trade norms, its inconsistent behavior is ceding moral and practical leadership to others. The European Union, for example, has moved swiftly to ratify climate-linked trade deals, while the African Continental Free Trade Area, AFCFTA, is quietly building momentum as a platform for South-South cooperation. Ultimately, trade is not just about economics, it's about trust, foresight, and stability. Until the U.S. restores clarity and credibility in its trade agenda, it risks becoming a wild card in a world increasingly built on predictable partnerships and collective frameworks. The United States finds itself at a pivotal moment. Rising protectionism, erratic policymaking, and growing global competition are threatening its traditional leadership role. Meanwhile, new alliances are being forged in silence between Beijing and Ottawa, Moscow and Beijing, and even within Asia's own economic networks, laying the groundwork for a new multipolar order. If America continues down this path of short-term populism and isolationism, it risks ceding both moral authority and economic leverage. The global stage is shifting, and the next act has already begun. The question is no longer whether the world is changing, but whether the U.S. can adapt before it's too late.